Good evening, friends. Hope you all are well and doing fine. I'm Ashok Kanawala. On behalf of HDFC Mutual Fund, extend a warm welcome to discuss this market outlook call on the eve of Diwali. Now, festival season incidentally will begin next week, but we just thought to have this call a little earlier because probably people will get busy with the festivities, and of course, some people will go on vacation, and therefore this call. Now, why this call assumes some kind of importance that although we have moved to financial year for our accounting year ending, but when it comes to Diwali, traditionally for last since the time since it's available, people have been doing some kind of activity, and this importance of Diwali still is maintained. And therefore, you will see a lot of calls happening, a lot of business channels covering the Diwali session. And so are we with this kind of call. Before I invite the speaker, I just thought let me set the context and why this call is very important right now, because markets have been going through a phase of correction, and the picture is right before you. So if you can see that from the peak in September of 2024, the markets have roughly corrected, depending upon the market cap, small, mid, or large, between 5 to 7%. But what we need to understand that from the last Diwali, the market returns are very healthy. You can see before you 38% roughly in mid and small, and around 27% in 50-50. And if I go back a little back in the history, March 20, which was the COVID bottom, if you see from that, so 4.5 years it has happened, you can see the compounded returns are very healthy. And the story is more or less same across time period, 1 year, 3 year, 5 year, and 10 and 15 years also. So uh, while people have been worried about this market correction, and we keep getting queries that what next, what we should do as an investor, bring to you one more slide, which is very interesting. For last 40 years, that markets have given this kind of correction every possible year. So you can see that every year market on an average falls by 10-15%. There have been time when markets have corrected more than 20% in a single year. And there have been very specific incidents. For example, you can see the security scams of 92 or a 2000 tech bubble, or in the case of global financial crisis of 2008, Eurozone crisis, or even recently COVID, when markets have corrected more than 30%, sometimes goes up to 50%. So those are extraordinary situations, but otherwise market in general have been correcting 10 to 15%, and we are not yet. I showed you the first slide where markets have still corrected around 7%, so which is like in a normal range. Whether we need to worry more or not, we will discuss that a little later when we have an expert with us who will take us through the analysis, his analysis, understanding of this economy and market. But for the present, from an investor perspective, this 10-15% correction is a normal thing as far as market volatility is concerned on a yearly basis. But what is more important for investors' perspective is the changing paradigm shift which has been happening in India since the COVID days. So just to give you perspective, unique investors investing in mutual fund, which were roughly 2 crores in March 20, today they are 5 crores. So 3 crores have been added in last 4.5 years as far as new investors coming to mutual funds. And similarly, when I talk about folios, that means one investor investing in multiple schemes, those nine crore folios have become 21 crores. At the same time, if I look at SIP, which used to be roughly around 8,500 crore in March 20, today it is more than 24,000. So roughly 3 times in last 4.5 years, it has grown. And similarly, the SIP account also from 3 crore 12 lakhs to it has nearly grown to 9 crore and nearly 10 crores. So I think this is the paradigm shift which has been happening. And therefore, despite FI selling big time, not recently, but even in the earlier years, earlier periods, I think markets have withstood and the journey onward has continued. So how this journey is going to pan out, because we are at the on the eve of Diwali, and of course we will be uh, very much keen to know how the markets will pan out over next 12 months, beginning this Diwali to next Diwali. So we have with us Chirag Setalvad, our head of equities. Chirag himself does not need any introduction. In HDFC Mutual Fund, under his leadership, the overall equity AUM is more than 5 lakh crores. And he himself manages roughly 1,40,000 crores. So people know that he's been associated with the small caps and mid caps for a longer period of time as far as those market segments are concerned. And mid cap, what he manages today is roughly more than 70,000 crores. It's the largest mid cap in the country, and another small cap, which is roughly 35,000 crores. So he has a vast experience of more than 2 decades and manages a very competent team under him. And the performance is right before you if you just see for last 3, 4, 5, 20, 30 years also. So with this, now I invite Chirag to make his opening remarks. Chirag, over to you.
Thank you very much, Ashok, and thank you, Ram, for hosting the call. And of course, thank you to all investors for taking the time to attend today. And before we start, of course, let me wish everybody a very happy and auspicious Diwali. I have a brief presentation for about 40 minutes, which covers both the economy as well as the equity markets. So the first part of the presentation will cover our thoughts on the economy, and the second bit will cover the more interesting part, which is equity markets, how they position today, mid caps, small caps, sectors, and so on. So let me start with a snapshot as far as the economy goes. And we have broken up the economy into two sections, into consumption and into investments. And just to put it into perspective, about 2/3 of the economy is driven by consumption and 1/3 of the economy is driven by investments. So consumption clearly is the more important piece. When you break up consumption between urban and rural, we are seeing quite a divergent trend. And what I mean by that is, on the urban side, we are seeing a slowdown, and that is visible across a variety of indicators. So whether you look at GST growth, which has moderated from 11-12% to the most recent number, which was 6.5%. The salaries of companies has also moderated from what used to grow at 17% to 11% in 24 to 7% in the first quarter of the current year. Passenger vehicle sales have also slowed down to some extent. QSR and retail companies' commentaries also indicate a slowdown on the urban side. And we've also seen a slowdown driven by RBI in part of unsecured lending as well. And I think this is somewhat to be expected. There was excess savings which had accumulated during COVID, and that excess savings has whittled down over the last couple of years, and I think that has impacted to some extent. There has been inflation, and I think the stated inflation is one, but the experienced inflation is actually possibly a little bit higher. And I think that has affected consumption as well. So we are seeing a little bit of a slowdown on the urban side. But on the other hand, on the rural side, we are seeing signs of a recovery. It is still very early days, but we are seeing, when you look at certain indicators like two-wheeler sales, when you look at work demand under NREGA, when you look at the commentary, when you hear the commentary of listed companies, FMCG companies in particular, they point out to the fact that rural demand is looking a little bit better. The worst seems to be behind us. And there is an expectation and hope that things will pick up in the second half of the year. The monsoon obviously has been better than expectation, 8% above the long-term average, and that sets a good foundation for better growth from a rural standpoint. Sowing has also been positive. We've seen almost 2% growth in Kharif crop sowing, and the rural terms of trade are also favorable. And what that means is the difference between food inflation and non-food inflation, that gap has increased. Food inflation is what the farmer receives, and non-food inflation is what the farmer pays. So when the terms of trade improve, there is more money in the pockets of farmers. So we're seeing a number of indicators, and you can see we've highlighted both positive and negative, and you can see that there are more positive than negatives. There is some slowdown which we are seeing in tractor volumes and fertilizer sales, but in general, there is an expectation of a recovery on the rural side. So let me summarize. I think consumption is an important driver of the economy. The urban part is slowing down. And on the other hand, we are seeing the rural part of the consumption piece is showing some signs of improvement. It is still too early to call out definitely that this has improved, but certainly we are seeing signs, initial signs of improvement. So it's a bit of a mixed bag as far as consumption goes. Let us move to investments, which is about a third of the economy. And we've broken this up into private capex and government capex. So let me start with the more positive news. I think private capex, which is broken up into household and corporate capex, is growing at a healthy rate. We've seen a smart recovery on the real estate front, and we can see that the number of launches have improved quite considerably. And this is visible in any city that you might be living in. I think household prices have also increased depending on where you are by 10 to 20%. So there is generally buoyancy on the household capex side, which is in real estate. Corporate capex is also quite positive, and that is reflected in the number of the cost of projects funded by banks, which you can see on the bottom right-hand chart. The real estate part is shown on the bottom left-hand chart. So private capex is continues to be strong, and we see that in company results as well, that order books are very healthy and order books are growing at a meaningful pace on a year-on-year basis. So this is the more positive part of the investment and capex story. I think the part which is a little bit more challenging is on the government side. And as most people know, government capex has really been a driver for growth in the last couple of years. Private capex has been weak, but government capex has been strong. And just to point out, both private and government capex are roughly equivalent in size. Government capex, private capex is larger than government capex, but we are seeing on the government capex side certainly a bit of a slowdown or delay. When you look at it year to date, actually government capex has slowed down by about 20%. It's fallen by 20%, and this is partly driven by elections. This is partly driven by the heat wave. And we need this to pick up, and the government is certainly committed to this. But capex needs to improve and grow by 41% for the balance part of the year for it to catch up and for it to meet budget targets. So there is a lot of expectation in terms of how capex from the government side will pan out in the second half of the year. We are hopeful that the second half will see a sharp recovery. So let me summarize this slide once again. On the investment side, there is good news on the private capex and household capex side, which is about 2/3 of capex. And then the government capex, which is about a third, is currently on the weaker side, but there is an expectation and hope that this will pick up in the second half. So when you put all of this together, and what we have in the next chart is what we call a heat map, which shows you various indicators across manufacturing, services, construction, etc. And what you can see is if you go back a year ago, most of these indicators were in the green territory, and now a number of these have moved into sort of pink or red territories, though there is still a reasonable smattering of green out there. Which indicates that there is a little bit of a slowdown. It is not something I think that is of significant concern, but I think it is important to see how the second half of the year pans out. There is a lot of expectation that the government capex will pick up. There is a lot of expectation around festive demand. There is a lot of expectation by corporates that the second half will see an improvement in demand. So there are initial and early signs of a moderate slowdown. It is not a significant slowdown. And even this story can change. It can change either way, to be honest. It can see an improvement if government capex picks up, particularly, or if it doesn't and urban consumption continues to weaken, then the second half may not pan out as per our expectations. So I think the factors we need to pay close attention to is rural demand, and does that improve or not? From the early indications, does it gain momentum? And as far as government capex, which has been slow so far, does that lever get pulled, and does government capex pick up in the second half of the year? So I think it's Indian economy, needless to say, we are still doing extremely well. So this is not to say that there should be concerns on India's growth. GDP growth at 6.5 to 7% is still far ahead of what you would see outside of India. US is growing at 2 to 3% and slowing down. Europe is just about growing and is in a sort of faces a lot of structural issues. China is struggling to grow at 5%, and we're not sure how reliable those numbers are. So in that context, India continues to stand out from a growth perspective. India's growth is head and shoulders above what we see in other large major economies. At the same time, India's inflation is also not a bugbear. India's inflation is broadly under control, unlike in the US, where wage inflation continues to be strong. The overall inflation has come down. Um, Unlike in China, where you have issues around real estate, unlike Europe, where you have issues around structural costs. So India doesn't face those structural issues, and India's inflation is also under control. And lastly, the political climate in India is stable, unlike in the US, which is going through an election and it is still unclear how things will pan out. I think the political climate in India is stable. So when you put all these three together, and these are the three factors that investors will look at: growth is benign, inflation is under control, and there are no structural issues, and the political environment is stable. So the point of the last few slides was just to highlight that there is a little bit of a slowdown which is taking place, but India's growth, it's important to point out, remains healthy and remains far above what you see elsewhere. And that is why you've seen so much of interest, not only from domestic investors, but also from foreign institutional investors as well. So that was a very quick snapshot in terms of how the economy is placed today. Let me quickly move to equity markets. I think this is where the interest levels are much higher than on the economy. So let's start by looking at the valuation piece. And I think there's a lot which has been spoken about in terms of concerns on valuations. I think the mid cap, small cap side in particular is where the concerns are, and mid caps and small caps have done extremely well. So let us put it into perspective. Today, Nifty trades at about 20 times. These three charts represent P multiples on a 1 year forward basis. When you look at the Nifty, it trades at only an 11% premium. And when you consider how well India is doing compared to the rest of the globe, I think an 11% premium is not an elevated premium. It is something which is quite, I think, sensible and reasonable. So large caps, as represented by Nifty, continue to trade at valuations which we think are sensible. And large caps are almost 2/3 of total market cap. So when you break up market cap and you realize that large caps, which represent 2/3, are trading at sensible valuations, it gives you a little bit more comfort in terms of overall valuations. Now, I think the issue is much more in terms of mid caps and small caps, because those parts of the market have rallied very, very sharply, as everybody is aware of. Now, post the sharp rally, we've seen mid caps now trade at a premium of about 40%. And contrary to popular belief, actually small caps trade at a lower premium of about 30%. So relatively, while both mid and small caps are expensive, the premium in mid caps is a little bit larger than in small caps. And and that's one of the reasons we are more positive on small caps from a longer term standpoint. But I think the other is there are a number of structural advantages in small caps. And what does that mean? Unlike mid caps, which is a universe of 150 companies, large caps is 100 companies, mid caps is 150 companies, and small caps is all other companies, which probably means 1,500 to 2,000 companies. So the universe in small caps is very, very large. So even when the universe trades at a 30% premium on aggregate, you will still find pockets where valuations are sensible. And in a market which is correcting, which it currently is, these pockets become sort of more prevalent and more visible. So I think that's one big advantage of the small cap category, is that the number of companies is far larger. The second is there is in small caps, there is still not the same level of understanding that you find in mid caps and in large caps. So as an example, a large cap company would have 30, 40, 50 analysts covering it, India's mega caps. When you go to mid caps in the same sector, that number would drop to 15, 20. When you go to small caps, the coverage of these companies falls to 3, 4, 5. So the level of understanding, the level of coverage of small caps compared to mid caps, compared to large caps, is far more attractive. There is less competition in that sense. Number of people following and tracking companies in small caps is far lower than it is in mid caps and in large caps. I think that's another advantage. The third advantage is that both in mid, there is a lot more volatility than there is in large caps. And I think that volatility people see as a negative. I see as a big positive, because volatility gives you, if you have a long-term perspective, gives you the ability to keep biting into the market when valuations become temporarily cheaper. So I think that's the third advantage. And of course, small cap volatility tends to be higher than mid caps. And I think that's an advantage that we can add value as portfolio managers by buying into difficulty, which we think is temporary in nature. So for these couple of reasons, I'm still a big believer that small caps over a longer period of time will do well. In the near term, because valuations are on the higher side, I think we need to temper down our expectations because there is a premium of 30% and 40%. Now, interestingly, both these premiums of 40 and 30 have fallen quite a bit. Now, market may have only fallen 6 to 10%, but we've also seen, as with the passage of time, the average itself, the 10-year average itself of valuations has moved up. So mid caps, if you go back a year ago, or if you go back 9 months ago, used to trade at closer to a 55-60% premium. That premium has actually dropped. Despite the market only correcting 6-7%, that premium has almost dropped by 20% or thereabouts, because the average has moved up by 7-8%. The market has come down by 6-7-8%, and therefore there is a 15% correction in valuations, which has happened actually quite quickly and has happened without significant disruption. I think the other point we wanted to highlight is we are also seeing some sector rotation. I think sector rotation is a part and parcel of markets. And rotation is interesting because it covers not just sectors, but it also covers style. It also covers market caps. What does that mean? Sector rotation means there'll be a period of time when large caps are in favor, and then that will switch and it will move into mid cap and small caps, and then again it switches back. Now, of course, the trick in this is how long in duration do these trends last? It can last for months, it can last for years. But we certainly see a rotation which happens from a market cap basis. And we've observed that for sort of many, many decades. We also see rotation which happens on a sector basis. So sectors which have done very well in the past will tend to take a breather, and then we have new leaders. And that's one of the points which we will get to in this slide, that we are seeing some degree of rotation taking place. The third form of rotation, of course, is in terms of style. And we talk a lot about growth versus value, and the market shifts its preference between those two. There are points of time when growth does well, and there are points of time when value does well. So I think that's always important to keep in mind, and not to chase momentum, but to realize that it is important to also be contrarian. And in the last slide, we will cover what we think is the most important, which is the right way for investors to approach markets. But we are seeing some degree of sector rotation at this present moment. We've had sectors like realty and PSU and defense and capital goods, for that matter, which had done extremely well, which led the rally till quite recently. And we've seen now that sector leadership has shifted to other sectors, including IT. And the one sector which has lagged so far, and we'll talk about it in the sector slide later on, has been financial services. But we do think that the environment is correct for this to also change. And we'll talk about that a little bit more when we get to the sector slide. Before we get there, we wanted to quickly update investors in terms of how the last quarter has gone in terms of earnings. This quarter earnings have just started, so it is still too early to call it out. But we have seen some degree of slowdown, and this points to the highlights the earlier point of the economic slowdown. It also gets reflected clearly in a corporate slowdown, and that's bound to take place. And we've seen sales growth, and this is growth excluding oil and banking and financial services, to make it a little bit, to remove volatility and make it a little bit more comparable. So we have seen revenue growth, which is the top line of companies, has slowed down from sort of 10-12%. It has slowed down to 5-6%. So there is a bit of a slowdown there. But what we have observed is that despite the slowdown in revenue, EBITDA growth, operating profit growth has been quite strong. And that's because raw material prices have so far been benign. And as a result, margins are at almost a 2.5-year high, at a 10-quarter high. And as a result, while Revenue growth has been 4-5%. EBITDA growth has actually been 15-16%, and EBITDA growth as a result has driven strong profit growth of 14-15%. And I think those are quite healthy numbers. And what you can see at the bottom left-hand side is the raw material costs, which have come down, which had peaked 51-52% of sales. That has come down to sort of 46-47% of sales. So the summary of this is that, yes, there is a little bit of a slowdown. Revenue has slowed, but because of profitability improving, because of lower raw material prices, actually operating profit growth and PAT growth has been quite healthy. And this is important because in the short term, while the market may sink to the tune of liquidity, over a longer period of time, the market will reflect corporate earnings, and we need strong earnings growth to continue. And as I said, we are hopeful that the second part of the year will see better overall economic performance and therefore an improvement in sales growth. While EBITDA margins are already peakish and may not necessarily sustain at these levels, we are hopeful that growth will pick up and hence overall earnings growth will remain benign. And the expectation of earnings growth is still at 16-17%, which is what we've shown the table on the right-hand side. I think there is a little bit of risk to this, but again, we'll have to see how the second half of the year pans out. Let me give a quick summary in terms of what we are observing at a sector level. I'll start with automobiles, where I think there is some slowdown, which is clearly visible. And recently, this has been covered by the press in more detail. I think two-wheelers are doing a little bit better, but we are seeing a slowdown in cars, in commercial vehicles, and in tractors to some extent as well. And as a result, companies are offering a little bit more in terms of discounts. That may push up growth a little bit, but it will impact margins. Festive is very important, and we'll have to see. It's still too early to call out, but we'll have to see how festival demand pans out. Banks, actually, the scenario is we've given a downward arrow, but I think it's a fairly balanced situation in the sense that while credit growth has slowed down, deposit growth has actually been quite reasonable. I think the RBI has been keen that banks bring down and converge credit growth with deposit growth, and that is something which we are seeing right now. So there is a little bit of a slowdown from a growth standpoint, but what we are seeing is that asset quality continues to be very benign. There are a few pockets, particularly in MFI and to some extent in unsecured, where there may be some challenges, but overall, asset quality continues to be very, very benign. And we've seen that in the recent results of banks, and especially the larger banks which have come out with the results, that growth, while it has slowed down, is still in double digits. It's still, I think, okay at a reasonable level. And asset quality continues to be very, very strong. Valuations of banks, so if you go to the top right-hand chart, it shows you which sectors are trading at what premium or discount to their long-term average. And private sector banks are the one sector which trade at a discount to its long-term average. And we spoke about rotation earlier, and I think this is one area where we will potentially see rotation of interest getting into banks. Capital goods, the order inflow, we spoke about this during the investment slide, continues to be very strong and growing at 20% plus on a year-on-year basis. The challenge there is, of course, from a valuation standpoint, because valuations here are quite elevated. Consumer staples is a bit of a mixed scenario. While demand is expected to pick up on the second half, based on above average monsoon, based on better rural demand, we are seeing some pressure coming in from raw materials. Palm oil prices, copra prices, coffee prices have moved up. Valuations in consumer staples, I would say, are acceptable. They are neither very expensive nor are they cheap. From a relative standpoint, actually, consumer staple valuations look okay. From an absolute standpoint, not as interesting, but I think it's more, I would say, a balanced valuation outlook as far as consumer staples goes. IT, the commentary of companies has been okay, quite positive. In fact, post the first quarter, we've seen some of the companies like Infosys up guidance. We've had global companies like Accenture come out with a better than expected next year performance guidance compared to the last year. So IT, while the US is right now doing very well. We have to be watchful to see if there is any slowdown, but US growth has consistently surprised. And we have a slide right at the end which talks about US economic performance. But just to highlight, from 9 months ago, when the expectation of US GDP growth was about 1.5%, that has moved up to 2.5, 3% now, or 2.5%. So there has been an improvement. The US economy has turned out to be far more resilient than expected. And now that interest rates are coming off, there is a hope that there will be a soft landing, and hence the demand environment for IT companies should remain encouraging. And the last is pharma. Here we are seeing positivity both on the domestic side as well as outside of India. In the US, which is the big export market for India, the pricing of generic products continues to be stable. So from what used to be a 7 to 10% decline on a year-on-year basis, that has come down to sort of 4, 5, 6%. So we've seen a moderation in that pricing decline, and that's good news for Indian exporters. At the same time, the domestic pharma market continues to grow reasonably well at 8 to 10%, and that part of the business continues to do reasonably well. So the overall outlook on pharma remains positive. So hopefully, through this slide, we've highlighted not just on valuations, and we've summarized valuations on the top right-hand chart, but also given some flavor in terms of outlook for each of these sectors. Important to again point out, and I know I've said this several times in the presentation already, but most companies are expecting a better second half, and most companies are relying, or several companies, several sectors are relying on better festive demand, those who are consumer facing, and hence we need to watch carefully what happens in the rest of the year. We thought we'd quickly highlight how fund flows have been. It's been a remarkable year for fundraising, and this is through IPOs and OFS and QIPs and all of that. But we have seen more than sort of $20 billion of money raised, and this is calendar year to date, so it's not for the full year. This is and we are comparing to full calendar years in the historical period. So we've already hit close to an all-time high in terms of fund flows if you annualize it. So fund flows have been very, very strong. There's been a lot of fundraising, not only through the IPO market, but even through QIPs and OFSs and so on. And there is a very healthy pipeline as well. So we've raised close to more than $20 billion, and there is a upcoming pipeline of another $20 billion, and we've highlighted some of the names. Hyundai now has moved from upcoming to completed. Swiggy is in the pipeline and so on. So that's a large fundraise. So this is something which can potentially put some brakes onto the market. And I think having some brakes and speed breakers in a market is healthy. It gives us an opportunity to get back into companies at more sensible prices. So I wouldn't be particularly worried about short duration corrections. But there is a meaningful pipeline which is there. Of course, the amount of money, both with foreigners and with domestics, is significant. I think domestics, as everybody knows, have taken the reins of the market, so to speak, and have pumped in $34 billion in the calendar year so far, compared to foreigners who've put in about 7 odd billion. And you can see from this chart that in most years, barring one, domestic institutions have been consistent buyers for the last 10 years. And that flow continues, that 24,000 crore monthly SIP flow, which Ashok pointed out at the beginning of the presentation, provides a strong foundation and bedrock and support to the market. Cash with mutual funds, we thought we'd highlight this because there is a lot of conversation about this. I don't think there is a significant amount of cash. I think there is some cash clearly, but it's not excessive. So we've looked at cash, it's about 5%. And if you assume that most funds would typically keep 2 to 3% cash for a rainy day, then the excess cash is another 2, 3%. So there is a little bit of support which will come in from cash, a little bit of support which will come in from SIPs, but there will also be a fair amount of liquidity which will get sucked in because of the primary market fundraising that is planned. We spoke about Indian valuations, so let us also put into perspective global valuations. And I think this is important because we don't operate in a vacuum in India. What happens outside of India and how markets behave outside of India will certainly have a role to play in terms of how our markets behave. So let's start with Europe. Let's start with the US, which is the top left-hand chart. And what you can see is the US markets clearly trade at a premium. So they're at about a 20% premium to their long-term average. So it's even higher than what you see for Nifty. And this is, of course, very barbelled in the sense that it is focused and driven by a select number of companies, the Magnificent Seven and so on, have driven valuations higher. In fact, the US is an interesting market because unlike in India, small caps and mid caps have underperformed significantly. So when you look at the Russell 2000, which is an indicator of US small caps and mid caps, they actually trade below long-term averages. So the US market, mega caps have done much better. Particularly technology and AI related stocks, those have done very well. Overall market is a little expensive, but there are pockets within that which are sensibly priced. Europe, because of the challenges it is facing, trades at close to its long-term average. It's neither expensive nor cheap. And a similar story for emerging markets as well. Trade close to long-term averages. I think the point of this, when you look at the China chart, it's a similar, it was below average and now possibly is close to long-term average. I think the point of all of this, let me summarize it by saying that most global markets are trading at close to average. Some are trading a little bit above, like the US, which is obviously the largest equity market out there. But it's not that valuations are very frothy outside of India. So in that sense, unless economic growth slows down or earnings growth slows down or there is a significant negative event, valuations themselves at this point don't pose a significant challenge. It's interesting how India's representation in global markets has changed. India now, compared to an average of 2.5–3% of global market cap, we are now at a peak. We are closer to 5% in terms of world market cap. We are third or fourth largest in terms of market capitalization. And hence, there is a lot of interest in India as well. It's easy to ignore a country when it is 10, 11, 12, 15, 20 in the rankings, but it's difficult to ignore a country like India growing as fast as we are. And when that market cap is significant and you can actually put meaningful dollars to work from a global investor standpoint. It is also interesting to see how top 4 markets are now driving overall market cap. So top 4 markets, are almost 2/3 of global market cap. So what happens in the US stock market, what happens in the Chinese and Japanese stock markets will certainly have a greater influence in this day and age than in the past because the dominance of these markets, including India, has actually increased. So in that sense, that is a little bit more of a risk. And the right is just the right table just provides a snapshot in terms of how we have performed. So while we have done well, actually Nasdaq and S&P have done even better. Surprisingly, DAX is not far behind, but that's after a poor performance in the years earlier. So that's a snapshot from a global valuation perspective. Let me come to our conclusion, and I have just a couple more slides, and then we'll hand it over for Q&A. Yes, there are some signs of the Indian economy slowing down, but we need to be watchful, and this is driven by urban consumption and government capex. We need to be watchful for the second half. We need to be watchful on rural consumption, which is showing signs of recovery. We need to be watchful that does government capex pick up or does it not? We need to be watchful on festive demand. Overall, that growth still remains healthy, but that healthy growth is tempering a little bit. China, a lot of conversation today about China and the stimulus and the effect it may have. There is some stimulus which is largely monetary in nature, which has been announced so far. The fiscal stimulus is still to come. But I think there is a determination now in China to help the real estate sector much more than much more than they've done in the past. But the structural story there is weak because there is still a lot of overcapacity from a real estate standpoint. So I think the stimulus will come, but I'm not clear whether the stimulus will have the desired impact. So again, this fear that a lot of money will move out of India into China, I think that is more tactical in nature, in the sense that is, when you say tactical, it is just, I would say, shorter term in nature as opposed to longer term. I think the long term story, whether it is from a cost advantage standpoint, whether it is from a penetration standpoint or demographic standpoint, and so on, I think India clearly stands out. The US rate cycle and cuts, reversal in the rate cycle and cuts has begun, which I think is good news. But I don't think it is a fait accompli. I think you still have to see how data pans out, because like in most markets, like in most things in life, it is mixed. You are seeing inflation has come off, but you're seeing the labor market is still tight. So if incrementally any of that changes, the Fed will react to that, and hence I would not, while of course rates are expected to come down, that may change a little bit in terms of pace depending on how data comes out. I think geopolitics, it surprised me that we have dealt with such geopolitical uncertainty as well as markets have, but clearly issues in Russia and Israel and so on. But at least some of the surprise factors are behind us. The surprise invasion of Ukraine, the surprise inclusion of Lebanon into the war, and so on. All of those things are, in a sense, been absorbed by the market. And to conclude, yes, valuations are on the higher side. Global valuations have now are a little bit on the higher side, especially in the US, but otherwise in general, okay. It is important to put it in a little bit more granular context, which we did earlier, that Nifty and large caps are only at 11% premium. Mid cap and small caps are trading at 30-40% premiums. Those have come down a little bit already. And when you look at it from a long-term standpoint, there are a number of structural advantages still left in the small cap side. So I think it's important to reduce one's expectations. That's one. I think it is fair to expect greater volatility going forward, but I don't think, after running a race as fast as we have, I think it's important that we take a breather. Otherwise, we will sort of get exhausted, and you will, at the end of it, then see a much bigger correction. So it's better to see a smaller correction earlier than a larger correction later. And I think that is what we are kind of undergoing right now. But let me get to what I think is probably the most important slide. We have spoken about the economy, we have spoken about markets and mid cap, small cap, and sectors, and so on. But the most important is how we approach investing. It is not in mid cap or in small cap. What's much more important, the most important, is asset allocation. And that means how much money do you have in risk assets like equities, and how much do you have in safer assets like fixed income. So how much of your portfolio? So most investors will focus on, do I have a mid-cap fund? Do I have a small-cap fund? Have I invested with a fund which has, leading performance or lagging performance? But in all of that conversation, I think the key that we miss out is how much of our portfolio is in equities? Is it 20%? If it is 20, you will be associated with a lower return. If it is 80%, you will be associated with a higher but more volatile return. So asset allocation is the most important, and asset allocation will drive portfolio returns more than anything else. That's the first part. The second is it's important to be contrarian. And that means that, invest more aggressively when markets are more challenging. Invest systematically, invest regularly. I think that is extremely important. But we have to supplement that by every once in a while putting in a more meaningful amount of money, especially when valuations are sensible. So for those who invested at the bottom of COVID, and for those who invested at the bottom of the financial crisis or after the IT bubble, the returns have been even more rewarding. So I think being contrarian is important on both sides, which means that when markets are cheap, put more money to work. When markets are expensive, then one can trim a little bit. But I would not take large calls, because to the first point, asset allocation is the most important driver of returns. The third point is investing for the long term. And I think after asset allocation, this is probably the most important. The longer, the better. So people ask, what is the right duration? Should it be 1 year, 3 years, 5 years? I think the longer, the better. Investing for decades is the right way of doing it. Forever investing is obviously ideal, but not every investor has that mindset. But even if you make the mistake of investing at the top of the market, or even if you make the mistake of selling at the bottom of the market, if you hold for a long enough period of time, then your returns still tend to be rewarding. And last, a mix, and we spoke about this earlier, a mix of SIPs and lump sum works well. Don't try and time the market. It is very difficult to do it. Keep your money invested as long as possible. And what we've highlighted here is our FlexiCap fund performance over a 15-year period. And the fund has done well. It's done extremely well. It has given 20% plus CAGR. But what is interesting is if you had remained invested for that entire period, your return would have been closer to 20%. If you had missed 10 best days, and this is 10 days out of a period, starting from 1995 onwards, just 10 days, then your return would fall to 15%. And if you missed 30 days, which is less than a month in a period of 15 odd years, 17 years, then your return will drop from 20% to close to 11%. So I think it's very important to remain invested as long as possible. With that, I just have two more slides to highlight about the importance of SIPs. I know the SIP book has increased substantially, and it is important to reiterate the merit of investing in SIPs and to move away from market timing. So if you had started an SIP this is from the global financial crisis, the peak and the bottom. And what we've interestingly observed is that if you had started a SIP at the peak of GFC, you would have had a return still at date of about 21 and 22%. If you had started at the bottom of GFC after the correction, you would still, if you had done an SIP, had a return of 22%. So actually the returns are fairly close, despite one being done at the top and one being done at the bottom. And the reason for that, of course, one is that the duration of time is significant and that you've invested on a consistent basis. So I think it's much less about timing in the market, and it is much more about time in the market, which matters. The same is true about the correction which happened in 2017-18. Whether you started at the top or whether you started at the bottom, you've invested for a reasonable period of time. And as a result, while your returns were slightly lower, if you started at the top, you still made a very healthy return. I think this is the point which we were trying to make in the key success drivers, is investing for the long term is extremely important. Asset allocation has to be looked at very closely. And one should do a mix of SIP and occasional lump sum and be contrarian every once in a while to enhance your portfolio returns. So with that, I think we've taken a fair amount of your time. We've taken 45 minutes. Once again, let me just thank you for taking the time to attend this call.
With this, we end the call. Summarizing, इंडिया का ग्रोथ स्टोरी इंटैक्ट है 6 से 7 8% के बीच में. देन ऑल्सो इट रिमेन्स अ गुड ग्रोथ स्टोरी व्हेन यू कंपेयर द अदर इकोनॉमीज ऑफ द वर्ल्ड. वैल्यूएशन वाइज स्मॉल एंड मिड कैप में थोड़ा ज्यादा वैल्यूएशन है, लार्ज कैप रिजनेबल है, but from a medium to long term perspective, even the small and mid cap investors need not worry. So with this message, we end this call. Thanks Chirag, thanks Ram for being on the call, and once again wishing all our audiences a very, very happy Diwali, and we will continue to meet you in the ongoing calls year after also. So thank you for being good patient investors.
Thank you. And happy Diwali once again. Thank you.
Yeah.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.